morning where we start our first panel discussion on capital. And I thank the panelists for taking time to join us on this Saturday morning. Before I get started, I want a quick introduction from each one of you. We'll start with you, Vijay, and tell us a little about yourself and the kind of investing which is your core.
Hi everyone, good morning, and thanks a lot Sachin for inviting us over. So I'm Vijay Singh Rathore, founder of Sunicon Ventures. It's an early stage fund. We have made close to 60 investments. We are sector agnostic. To be exact, we have made 9 investments into D2C. And then our favorite sectors have been the climate tech. Then we have done drone tech a lot. So you can just check out website for the exact portfolio size. We go up to $500,000 in ticket sizes. And our office is in Gurgaon, and recently we opened up Jaipur.
Thank you for having me. My name is Dhruv Raj Behel. I'm the founder and managing partner of Sadev Ventures. We are a 240 crore early stage investing fund. We're primarily an operator VC fund. We're sector agnostic. What we do is we invest anywhere between 2 crores to 10 crores as a co-investment along with some of the top funds in the country. Like we've done one with my friend Abhiram here, and we do multiple others with some of the top funds in the country. And the idea is that because we're a purely co-invest fund, the time that we save in sort of boiling the ocean and getting deals is the time that we spend with founders, helping them build, grow, and succeed. And that's what Sadev as a differentiated fund stands for.
Good morning, everyone. I'm Abhiram, partner at V3 Ventures. We are an early stage consumer brand, consumer tech focused investment firm, part of a larger Belgium headquartered group called Wolinvest. We've been investing in India for the last 15 odd years, both at growth and early stages. I look at the early stage part of the business. So yeah, happy to be here, and thanks Sachin for inviting us.
Hi, morning everyone. This is Akshat Saxena. I work as a principal at Altiria Capital. We are India's largest venture debt fund. We are the founders of this asset class in this country. Till date, we have deployed almost $1 billion across 240 startups. We focus across sectors, but consumer remains almost more than 50% of our investments, whether it's consumer brands or consumer tech. I, for one, love consumer and have been doing it now for almost half a decade.
So Akshat, I'm going to stay with you and ask all four of you the first question. So first of all, a round of applause for our panelists here. There's a lot of money to flow in businesses, consumer businesses. So Akshat, tell us what has really changed over last couple of years, let's say from 2022, what has been one change? And if you can align it around consumer business.
Yeah, I think when we look at the last wave of deluge of capital that came in 21-22, a lot of focus was on just raising capital and just growing. I think along the way, markets have also kind of responded differently to different types of growth, which has meant that founders have kind of also started thinking about responsible growth, but also the cost of capital at which they are raising the capital to finance their growth. We are looking at exits that are happening at IPO, which are possibly below valuations that people thought they would get, which means that whenever you're raising the capital, what is also important is the valuation, how much you're diluting yourself, what's the cost of capital at which you are raising. And this is not just about late stage, but the funnel actually starts from early. I think that's a very decisive change that has happened. So we are looking at alternative forms of not just financing, investments, M&As. How can you be more efficient while you continue to grow? That's as a focus area.
Fair. I'm going to come back to you on that. Abhiram, you want to add something, any change, anything that you want to highlight?
Yeah, I think Akshat covered on some aspects, but I think at the top of the funnel and at the end of the funnel, both we have observations. I think number one, there's a lot more consumer brands starting up every day than ever before, and we are seeing a lot more consumer founders than we have. We've seen a lot more founders of the past 3 or 4 years than we have ever seen before. At the same time, the market has become extremely fertile and lucrative for exits for consumer startups, and obviously Mamaearth sort of started that wave, but we're also seeing acquisitions happen at a much younger scale of a business. A brand like Cosmix is a great example, right? Or True Elements that got acquired recently as well. So I think the spectrum or horizon for exits has started happening at a much younger stage of a company, which also bodes well for the investment ecosystem. So I think those are the two things I'll highlight.
Dhruv?
I think they're more in the thick of things. I'll take a step back, right? 40% of our investments are in consumer. When we look at consumer and you know when you look at when you add our fintech investments and the consumer fintech investment, that gets us to about 75% of the fund corpus, right? What we really see is that there is a shift that's happening. There was a time, and this has been maybe the last 15 years. First, it was बहुत population है, बहुत लोग हैं, something will stick. It was an adoption rate. Then it became GDP per capita. Oh, it's increasing. That means people's propensity to spend is increasing. Now it's become a percentage of that, which is the consumption. What is your, per person consumption index that is happening? What I'm seeing now is it is now becoming loyalty. I think loyalty is becoming the next metric. So what we are now beginning to see is that the brands that are really going to be able to survive in the future are the brands that have the ability to create brand differentiation of the product and the ability to sort of keep the customers loyalty engaged. Loyalty is no longer customer to brand. Now it is brand earning continuous loyalty back from the customer. So that what we are seeing is a big shift that I am now seeing is you have brands like, a brand like Comet, where you have people now becoming advocates of that brand, but Comet also doing so much more on content and work to sort of get it in. We have a brand in our portfolio called Asaya, which is, doing a lot more in helping people become proud about their brown skin and their brown skin heritage and sort of building beauty products specific to them, to people. So I think there is the shift that I'm really seeing is people are becoming more aware, consumers are becoming more aware, brands that are now building for it are building on not on LTV or CAC or all of these big metrics. They're building on very simple things like engagement, loyalty, and repeat behavior.
So what you're also saying is what we're seeing in the creator economy. You've got followers becoming your customers because they believe in what you stand for, and that's happening. But what's also interesting is that for a very longest period of time, we've been working on financing franchising, and what is critical in India is that brand is not valued as a asset, right? So one of the projects that we are working on is how do you put an asset value to a brand, and I think what you're saying is a kind of a pivot which is happening. Vijay, any remarks on what you're seeing in the last couple of years change? Then I'll come to specifics.
Sure. To speak on the last part of the question, I guess they have added most of the things. I will just add an investor lens to it, right? So when we started Sonicon Ventures, I guess D2C was the least favorite area of mine because I thought we will do deep tech, and we will love doing that. But eventually it happened to us because we were a democratic platform, and we saw whenever we pushed one D2C deal on the platform, the angel investors who are investing with us was quite curious to know about it. And that's how all our portfolio companies came in. Today, I'm proud to say that the company which has gave us 15x into 2 years is a D2C brand, right? And that company is Mitra. It's getting relisting through reverse merger. So my point is, as 2122 co-panelists said that there was a wave of investment flowing in. Investors always had interest, but eventually now we have seen that the rushing or the chasing of the top line is no more a metric. It's always how the unit economics will work from day one. It has to be figured out on day one. It should not be कि हम लोग पहले customers ले आते हैं उसके बाद figure out करेंगे profitability कैसे आएगी. So you have seen that shift and change, and those hard questions are coming on day one now. It is not a 2 years, 3 years कि उसके बाद जाके we will ask those questions. So we have seen good, smart, street smart founders coming coming in this area and then taking it. Yeah.
Okay, I'll stay with you on that, and I endorse it because since 22, we've seen more D2C franchise clients in our portfolio than ever before. And one of the reason is what Akshat spoke about, that there's kind of a discipline in entrepreneurship and startups which is being sought after when it comes to sustainability and being more responsible to the fund you raise. But what are the key factors apart from that which you would want to see, especially in a D2C brand or a consumer focused brand? And how does an asset light model like franchising play in your investing plan?
See, the most important thing for any D2C brand today is offline expansion. So I would always look into a company if there's only internet and going on to the e-commerce. I guess that's a red flag, because India is a much bigger market offline, and I would always bank on a company which has figured out that part, so where the franchise section comes in. And in that too, I would love to see how they have played the FOFO and the FOCO and then the COCO models, how they have made a bit of fusion of it. But that's one thing we always look into, how the company is going to be offline, be it super premiumization. They can go on and create only experience stores, but they have to have an offline presence so that people can footfall and have a check on it. And then if it's a consumer brand, they can go and expand across. Second is definitely the super uh, rigid process by how they have set up their franchise stores. We have seen brands falling out because after 2 years, 3 years, there is no specific audit of checking how the franchise models are working, and then there is the experience of stores goes down. So I guess we avoid that. So processes on day one is the must for us, and then the team has to be super solid, having a similar experience with this industry. One example, I won't take a name, but where we were quite bullish on that company, they rushed up to 100 stores, but the processes and the team which was hired later was not capable enough to keep the quality intact. So I guess these are the measures we look into a brand which is
No,
coming.
absolutely. Well, Mama Earth was a great story, but I think my favorite is Lenskart, you know.
Absolutely.
And the kind of work we've done in franchising in Lenskart, not just in India, globally, is phenomenal. And I think that kind of answers the kind of.
I loved your example. So I wear Lenskart from 8 9 years, or I don't remember the exact years now. But when I first saw the store, I got sold to that brand because you just go there, you experience it. They're not selling it; they're just ordering a book, and then it will come again shipped. So from the website, I landed to a store, and then all my specs, my even daughter, my wife, everyone wears from the Lenskart itself. So that's
Yeah,
a great example.
Piyush was a neighbor, you know, and we had a very small arcade outside our house. And as a promoter would, probably he opened a very small shop, like 300 square feet kind of shop. And the kind of engagement we saw, the whole arcade now is a lens card, and that's the proof of growth that you're seeing. You know, Dhruv, I wanted to understand how the approach from your investing, especially when you are seeing what you're hearing, give us more insight on the discipline and the sustainability. What kind of how it's pivoted in terms of assessment.
So, very interesting. Okay, so I think three things, right? When I think about that, the first is most importantly, I think the general sense has changed. So there's a very old adage which says that the capital should be predicated on the model should not be predicated on the capital, right? And what it effectively means is ki, don't put the cart before the donkey. Don't raise money and then think what you'll build. I think this awareness of hyperscaler events happening using capital are happening when there is multiple things figured out. Earlier, it used to be a semblance of PMF, and you put money and you hope that it sticks, right? You keep throwing money at it. And unfortunately or fortunately, we've had examples. One of my favorite companies right now, forever it's been, Blinkit, is an example of that, right? For years, you just got people to order quickly, and today, you don't even realize you're paying anywhere between 21 to 45 rupees to get products into your house 5 times a day. And it's quite viable. We've all become super users of quick commerce. But I think that has now changed. So what has now changed is it's not just PMF. It's, have you cracked a need of the industry, solved it? Have you then built a roadmap to, let's say, a larger revenue, not just profitability, but a larger revenue spread over multiple use cases, because you can't be a one-trick pony. And then at some point in time, have you also solved the softer aspects of a business? Like, can you attract leadership? Can you delegate? And that's really, if you draw a parallel to it, that's what franchising is, right? The first level of franchising happens within an organization when you build a business and you hand over to multiple CEOs or CXOs and say, अब ये तुम्हारा है, अब तुम चलाओ, मैंने contours and founders mentality दे दी है. Now you figure out what happens, right? The second big trend that we are seeing right now is the world of FOCO is dying, in my opinion. Franchisee-owned, company-operated is dying. Now what is happening is you're building off-balance sheet investment books. And the term I use is called FICO, franchisee invested company operated, right? Or franchisee invested company oversight. Operator is someone else, balance sheet is someone else, and contours of the business is someone else. So I will come, I'll raise money from someone else, give them a guaranteed return because I know what the model can give me, keep something in my pocket, and my company will give me the contours. And I trust that the brand that I'm betting on has figured out 4 to 5 times more problems to solve so that sustainability can be solved. And I think the third one is I just feel that there is exceptional talent in India. So a lot of the earlier bets we are taking are really on solid founders. Like one of the bets we've recently taken is someone I've known for 10 years. She built a business before. It had a good outcome, but it didn't have a great outcome. But what you saw was founder maturity. You're now seeing a lot of first time, second time sort of failed or struggled entrepreneurs now come back with a higher degree of maturity, a higher degree of understanding what needs to be built, how it needs to be built, why it needs to be built, what is expected in behaviors. And I think the success is now also equally riding not just on capital, but also on founder maturity.
I'm going to come back to you, Dhruv, on that. But one thing which you've spoken about has been very underwritten in this world, which is what you call as management contract. There's a company called Complex here, which is just got listed on a small exchange, and it's a complete franchise model, and company franchisee owned and company operated, or franchisee invested or company operated. Abraham, how does the demand look like, and what is your bet at this point in time from a consumption play? You would go for premium space or a more mass space, and this also reflects on the Bharat opportunity we speak about.
No, I think this question is not binary at all. I feel there are opportunities both at the premium end of the spectrum as well as at the mass end of the spectrum. And I'll explain. I think India has, obviously, India is not a homogeneous country, right? So we have various personas of customers at various ends of affordability, awareness, digitization, etc. Right? So we have a class of consumer brands that we've invested in who are targeting this premium tier 1, tier 2 cities, are aware of what's going on around them, have the willingness to pay a higher amount or a premium to buy a cleaner, healthier product, be it inside their body, which is nutraceutical supplements, food, or on their body, which is beauty, personal care, or around their body, right, which is health, wellness, lifestyle, sports, etc. Right? And then we have brands that cater to that environment. So we have a brand called Go Zero. Go Zero is a healthy ice cream brand which sells a scoop of ice cream at 75 to 80 rupees on average. It's much healthier than your Amul, Baskin Robbins, etc. of the world because there's zero sugar and half the calories. Right? So we have a spectrum of consumers who are willing to pay that premium. That business is doing phenomenally well, much better than what we would have thought at this point. Then we have a brand called Super You. Super You is a protein snacking business. I wouldn't say it's too premium, but it's also offering a much healthier replacement to your bag of potato chips, to a much healthier replacement to your Kit Kats or other snacks that you have during the day, and enriching all these products with protein. Right? But at the same time, we are also investors in a very interesting business called Lahori. And I know Saurav's a speaker in some of the next session. So Lahori is also premiumizing the customer, but not on price, right? Lahori is replacing the behavior of buying a banta, which is an unhygienic product. But this customer is never going to pay a 50 to 60 rupee price point to premiumize this product, right? So what Lahori's insight was that obviously in F&B in India, you need to cross the barrier on taste, right? A customer is never going to buy a product that doesn't taste good, no matter how cheap you sell it. So once you cross the barrier on taste, you have to offer them a value add, and the value add through which Lahori premiumizes hygiene, right? Especially after COVID, consumers became so much aware about the fact that you can't be having that banta soda and expecting you to maintain good health, right? So, but at the same time, India is a country that loves its fizzy drinks. In fact, Sprite sells more than Coke in India among the brands that sell a lot, right? So India also likes clear drinks. So they made a clear jeera soda, where you could also see the particles of jeera inside, which builds trust and authenticity, which means that this product is very close to the banta that you will buy across the street. But I'm offering it at a 10 rupee price point, which is also the same price you would buy a glass of banta at, but it's hygienic and clean because it's made in a factory, right? So I think brilliant insight. Right now, it's 1,000 crore plus revenue business today. So, but again, that's building at the mass side of things. So I think India has different consumers at different spectrums. Platforms like quick commerce are opening the funnel for this tier 2 and beyond customer, because the next wave of dark stores being opened by these platforms is going to be tier 2 and beyond. Franchising is another great opportunity, because franchising opens doors for tier 2, tier 3 cities. And what's important to note is, in these geographies where Bharat's consumer exists, which is the next billion consumers from India, their level of aspiration is very different, right? So their willingness to buy a new brand is much higher in a tier 2, tier 3 city as compared to a tier 1 city, because a tier 1 consumer already has 10 other brands they will compare a particular brand to. So I think all of these factors are really going to open up that tier 2, tier 3 city wave of consumption. It will be driven by mass, but at some point these customers also start premiumizing, as we are seeing in tier 1 cities. So I mean, opportunities are aplenty at both ends of the spectrum.
No, very, very interesting. I'll give you a very quick example of, and I'll stay in the franchising side of things. Very early days, about 2020, 2002, 2003, we invested in a brand called Dosa Plaza. I don't know how many of you know this, but the story is not what it is today. It's on most of the international airports. It used to be a cart outside a railway station, and that's where we invested along with one of the malls which are coming next door. So we invested in, and another brand which actually did exactly what you told us is a brand called Jumbo King. I don't know if you know them. So they just figured out that there was a vada pav which was 5 rupees in an unhygienic manner, and they started selling it for 6 rupees. So before I come to the closing question, Akshat, when a founder should consider an equity versus a debt, and should he actually consider a debt?
Yeah. Yeah, I think it's not, again, it's not binary. It's not either or.
Sure.
It's mostly works well in tandem together. There are use case that you would ideally use equity for, and the use case for which possibly debt can solve for you. So typically we see, right, maybe upcoming consumer brand, wherever they have crossed an MRR of maybe 2 to 3 crores, that's when they become eligible in some ways where the business has a certain defensiveness, so that they can absorb a little bit of debt capital. And then as the journey grows, you continue to use debt to optimize on your cost of capital, right? So we invest in companies. We invest maybe $500,000 in companies which are making, let's say 3 to 4 crores a month, and we then invest in companies which are doing 2,000 crores annually worth of business, and those investments are maybe $20 million in all. So most of these situations, it's a mix of two. I would say when companies cross a certain threshold, which maybe look at maybe a growth stage company, where you can actually finance some of that growth independently by debt as well, instead of just equity. But those are more late stages. Think about companies which are already valued at $300 to $400 million and beyond. At that scale, there's a lot more defensiveness to the business, and you're actually just solving for maybe the newer products and newer markets rather than questioning the core business in itself.
Yeah. Dhruv, I have a follow-up question with you. And what sustainable growth means for founders today? You were mentioning about it. I just wanted to sort of let you elaborate on it.
So I think sustainable growth, there are multiple interpretations to it. One of the interpretations, if you look at late stage private equity, is purely always be profitable, right? Never always have wholesome profitability, maintain it over years, so that if you need to pull the IPO trigger, we can. I think in early stage it changes a little bit. I think in early stage the word that I use is called controlled burn. The ability to control your burn. आपको पता है कि I'm going to burn 5-6 crores or 10 crores or minus 3% EBITDA, and I know exactly how to turn it down. What will my elasticity of loss be on top? And I know when to turn it back up. We've invested in a company, and I love those founders. Then there's a company called Prosper. They're a flexi benefits technology, consumer and B2B SaaS platform, help people plan tax and wealth. I love how those founders operate. You know what they do? They start the year by saying, look, I'm going to burn $100,000 a month or 1 crore a month. At the end of the year, I have a 1-year AOP. At the end of the AOP, I'm going to get to zero. So over a 12-month period, it's going to be 50 lakhs times 12, 6 crores. But you'll see me burn a crore right now, and you might see me burn 80, and I might burn like nearly 70% of that within the first 3 to 4 months. But what I will set myself up for is what is going to get profitability over the next 8 months or get me to that lens. I think the ability to stop throwing darts in the dark or spray and pray, which is something which has been taught to us. Keep iterating. Intelligently iterating is what is important for sustainability. Unfortunately, there are not many um, proxies for that, and those who do, they're so busy that they don't go out and I think communicate it much out. So it's left to the VCs and sort of the investors and the board members to try and spread it around. One anecdote I have there is, I think startups don't focus on governance as much. We don't think about what does a board member bring to the table, what does color of money mean, which VC will bring me what to the table. We've seen this. People coming to us really ask us, okay, you say you're an operator VC, I have these 3 problems, show me how you'll solve them for me. And start asking questions. I don't see a lot of that governance culture in a lot of other places. And I'm not talking about malfeasance governance. I'm talking about day-to-day governance and governance that leads to improvement or the marginal utility problem being solved month on month, quarter on quarter, year on year. So I think when you start solving a lot of these things together, that's where I think sustainability comes in. And if you think about it, there's a saying when we used to be at Bain, right? There's a whole book written on it saying repeatability, sustainability, scalability. So repeatability comes first. Can you do this again and again and again more efficiently? And I think AI is all about it nowadays. So, but can you do it in the consumer in the offline world? That leads to sustainability. Are you doing it profitably? And once you do those 2 things, हर 1 रुपये से 2 रुपये बना रहे हो, then scalability will someday kick in.
Understood. So, final remarks. What change you see in next 3 to 5 years, and especially on the Bharat front or tier 2, tier 3. Vijay, you're gonna go first and give us your thought on it.
See, I don't know how many of you have seen that now Domino's have a cart. They are bringing up a small, a vehicle which is set up in the Mumbai Expressway. So that was quite surprising for me. So my pointer is now, if the bigger brands are coming to that level to have expansion across, that's what the rest of the brands have to. They have to enter tier 3 markets, even if they can do tier 4, great, but tier 2, tier 3 has not to be missed, and be very frugal in setting up things. So I guess that will change for the founders. Instead of only focusing on tier 1 companies, which is quite hoarded. Earlier we used to see कि कोई भी product launch करना है पहले Bangalore में कर लो, because you will have those premium customers. But recently we have been doing a lot of activities into tier 2 cities, and we have seen a lot of money is in the pockets of people who are into tier 2 cities. And there is a term for this, Henrys. So we call them higher earning, not rich yet. These people you will see across in tier 2 cities popping out. So you can position your brands into tier 2 cities, even tier 3 cities, if that's a market you should definitely focus upon.
I think great point. The only one thing I'll add to this is I think I'm seeing a shift in dynamics. I mean, just trying to think of what is the most unique thing that I've seen in the last couple of years is actually a more active participation of the female workforce. Women becoming financially independent, taking their own decisions, becoming financially literate as well. It's not like there's not been participation in the last 20, 25 years. It was always like, okay, you decide where to invest. But now you're seeing with all these fintech apps and so on and so forth, people are becoming self-sufficient. Either a male or a female is becoming individual. And it's changing dynamics. Like, I'll give you an example. We've invested in a men's fashion brand. And we were trying to study why is men's fashion suddenly becoming big? Why is, Bliss Cup doing so well? And what we realized was it's actually the female partner, the female significant other, who buys the first product and hands it to a man before the man becomes a repeat customer. So the man is nothing if there's not a female consumer, right? So I think the power of the female diaspora in India and its increasing impact in terms of financial availability is really going to change a lot of things, right? You're seeing premium skincare, seeing premium beauty, you're also seeing premium fitness, you're seeing, a lot of these things happen. I think there's also going to be an impact, inverse impact, where they're going to start opening up things for the family as well. You're going to see baby care, baby food pick up tremendously in the future, because as they work, they want clean label brands providing for their family, but they don't have the time to, they're not in the kitchen anymore. There's the Didi in the kitchen who they've hired. They have to give instructions. They have to hand them products that work for the family. So food, clothing, men's fashion, they're all going to be, in some sense, catalyzed by all of these great women who are in the workforce and really powering it.
Yeah, very interesting. In fact, I was doing a project for a large company on home automation, and what they specifically told me that the architect should mostly be from tier two, tier three, because that's where they see a very large adoption of that. So and it was a pretty expensive solution they were selling.
I mean, not relevant, but a great point. We're a VC firm with 85% of our team is extremely sharp and smart females, and they're sort of the ones picking the portfolios, growing the portfolios, and we're doing really well. And I'm like, okay, maybe if you boys just back out, they might even do much better than us then.
Interesting. Go ahead.
I think I'm going to go back to a buzzword. I think the use of AI to personalize consumer experiences, I feel, is going to drive the next 3 or 4 years for sure. And we're seeing it in our portfolio as well, right? And biggest success story from our portfolio today is a business called Cuckoo FM. Cuckoo has some 1.4 crores and growing. The latest number might be like 1.6, 1.7 crore subscribers, paying upwards of 100 rupees every month to consume content, right? Which means that most of our consumers are from Bharat. They're willing to pay more than 100 rupees a month to consume good quality content, and we are able to push out 400, 500,000 hours of content every year to this consumer thanks to AI. Right? And now we're also pushing out video content in addition to audio content. So obviously, thanks to platforms like UPI, AutoPay, the proliferation of consumer tech consumption of content in India is growing. AI is only going to enable it in more areas like this. For example, astrology, which is the biggest market in India that we feel, right? And AstroTalk has proven that. Can we use AI to create the same experience that a consumer feels when they talk to their Jyotish, when they go to their family Jyotish, right? That family Jyotish has so much contextual knowledge about you, your family, their habits, their past experiences, their lived experiences. We can translate that into AI through a shared memory layer and use that to provide contextual advice as compared to an astrotalk where you go to an astrologer, the astrologer has no idea about your past, no contextual knowledge. Can we use AI to sort of enable better experiences? At the other end of the spectrum, which is the premium spectrum, we have a brand called CuraPod that we've invested in. It's a pain management wearable device. They are using AI to figure out what amount of dosage should be given to you through they have a wearable device that provides red light based therapy to alleviate pain in your body. So they are using AI to figure out what should be the right dosage for your diagnosis, so that your pain alleviation. So if I have knee pain, which is a level 3, level 4 pain, versus you having a back pain, which is level 6, level 7, the dosage that I receive from the device will be very different. They're using AI to figure out how can we optimize that experience. So I think different spectrums.
I think just adding to what Abhiram said, we are continuing to see not just brand, consumer tech, but enterprise companies focusing on AI not just as a way to make it more personalized, but also figure out new ways or new adoption criteria. Say, for example, and maybe a relevant example for this room might be how can you have a more omni-channel kind of experience for your customer, where when the customer walks into the store manager already knows 10 things about you, right? So through your own D2C experiences, through your touch points on the internet, I mean, the store manager, even while you are entering, through some sensors, they are able to detect who is entering, etc., what are the characteristics, and then can maybe create a moment of joy for that customer even before the customer has actually decided to maybe buy something, right? So that is something that potentially a lot of analytics could have done it, but I think AI is helping it do it just faster, potentially can add significant value.
Interesting. I don't know if we have time for some questions, Benny. Do we take some questions or we? Okay. Show of hands if anybody wants to have a follow-up questions with. Okay. So we'll probably do it offline. You have one. Can we have a mic here? We've got two questions. Please address the panelist you want to ask.
Hi, very good morning, everyone. First of all, congratulations for putting together such a great event of this scale. So, my name is Arshia Kasba. I'm a lawyer. So, my question is to everybody on the panel. Um, this group especially has so much visibility across brands, right, of different scales. So, I just wanted to understand, do brands, founders from the get go, how are they approaching IP when they start? Is it something still on the back channel? Is it something that is encouraged at the funding stage? Just wanted to get some perspective on that.
Very good question. Who wants to take that?
Yeah, I think it's very difficult to find consumer businesses with true IP in India because everybody is living on shared resources, be it on the manufacturing side of things or services, right? And a classic example is beauty personal care products. A founder may say that we have an extremely patented formulation technology. It's all a question of going to the manufacturer who makes that product and figuring out how it's made. Having said that, I have invested in companies that have true potential of IP. This Curapod, which is a pain management device business that I talked about, they have a US FDA CE registered patented device, and these founders truly understand IP and product, right? They formulated this. I would say they are better product and IP people than brand people, and we're helping them on the brand side now. But they formulated this product purely based on the insight and IP that they had, and they believe that they have come up with a technology which is truly irreplaceable, and it will probably take somebody else a long time to figure it out. Similarly, we've invested in a company called Extovia. Extovia is a bond repair hair care brand started by two founders, one of whom is a R&D scientist. He's been working in R&D in beauty personal care for the last 30 years, right? He's worked at Calvin Care, Marico, etc., etc. He's come up with a bond similar to how Olaplex has that bond. Olaplex has a bond that a molecule that is patented. We don't know what goes inside. Similarly, Extovia also has a bond, and nobody knows what goes inside because it's behind a patent. And this patent's already been granted to us. So us as investors, when we engage with these founders, we do something called technological due diligence. And obviously, we're not experts to do it. So we rely on people like you potentially or others who provide the service to us to help us gauge the defensibility of the IP. Having said that, IP as a moat, I believe is super strong, especially in consumer business. There's a brand called Inito. I don't know if you've heard of it. It's a fertility monitor device. Again, solid IP-driven business, right? So IP is a moat that is rare to find and often under recognized in the consumer world at least. I know it's more valued in the tech world, but I hope that India comes up with more IP-led innovations in the near future.
Very interesting. We'll take the last one here. Behind you. Yeah.
Hey, hi. I'm Himani Goswami. I am founder and CEO of Vikasya. It's a faith tech platform. So, because you talked about astrology market, so I have a question from you, Abhiram. That how do we? So, I think this is the kind of business where human intervention is very, very important, and also usage of AI in such a sector and industry is also important because the market demand. So, how do we understand the difference between what to keep, where to keep human intervention as is, and where to also get AI included?
I don't know if anybody else wants to take a shot at it. At least from where I stand, I think there are platforms which have been notorious of not disclosing when the customer is interacting with a human and when they're interacting with an AI. I think that's a big red flag for me because this won't fly in countries outside of India where there are extremely strong data privacy layers. I believe that this works on faith and trust, much like the word itself is faith tech, right? So I think the moment the faith or trust is broken, your brand doesn't stand for anything. So I think transparency is a key factor. Having said that, using AI to optimize the customer's flow, using AI to develop the brain or the engine, right, the decision making engine that I talked about, is a great avenue. And whenever you want to escalate or transfer the conversation to a human, I think it should be with the consumer's consent and with their awareness. I think The moment I stop giving that amount of transparency to my end consumer, I'm breaking their trust. So that's why.
I'll sort of add to that, right? We are investors in Vama, and they're the second largest platform after Sri Mandir today in the country. And one of the big things that they've done is they've not done astro too much. While one of the co-founders is a PhD in astrology, they have not done it. And I think the question to that is trust and quality of talent. So I'll draw a parallel to this to the stock market, right? You have a lot of people who will come and say, join my Telegram channel and I'll give you advice. And you don't know whether that advice is right or not. There are times people will take an RIA exam and do it, but will not have fundamental knowledge behind it. So even if they were certified by the regulator, they are not maybe the right person to give you advice. And the advice they give you could lead to significant sort of loss to you and at no loss to them. And by virtue of that, I think you take that same sort of corollary and attach it to astrology. And if you believe in it, and I do believe in it, it could really have an adverse impact on you, mean nothing to that person. And by virtue of that, if there is, like today in medical science, what in the US is happening now is people have medical LLMs. As the doctor's writing the prescription, it's reading through saying, right person, right prescription, no drug interaction, right thing. It'll tell the doctor, protects them from malpractice. Could you possibly use AI like that in a human intervention? Yes. Could you possibly replace the first level of human intervention? क्योंकि आपको पता है पहले 80% questions तो same ही होने वाले हैं. And then it goes to a master or a guru whose dominance and preeminence has been defined and established. And so the number of human interactions are less, but they are more meaningful and significantly of a higher value. Just draw a parallel. AstroTalk is the largest. I won't say exact numbers, but Vama tends to charge maybe 15 to 20 times per interaction more, just because they only do quality interactions and they don't do the average, just pick up the phone and talk to any tarot reader kind of view, right? So I think there are a lot of models which are already playing with this in every sector. You can pick and choose what works for you, but at the end of the day, it's which customer you are going for. The premium customer does want human interaction, but they also want it to be accurate. They will also have it validated third party. To give and just to tell you, this is an experiment. We've done this experiment. We've taken out predictions. We've gone to some of the top astrologers to test it, and then we've asked Claude to take it out. And Claude has actually picked up things that even the top astrologers have missed in people's kundlis. So I think that the point is that there is an AI dominance that is about to come. Is it going to remove the human touch? And will people then realize that they don't even need, even the most premium segment doesn't need human interaction? And they should just trust that and the solution that comes from it. And it's a new day and a new field for everyone.
Very good. That's all we have
Thank
time for. You want to take one question very quickly, please? Go ahead. Introduce
sure.
yourself.
Hello everyone. My name is Shambhavi. I'm a co-founder at India Law Shield. So I just want to know from you guys, like how you see legal services market in India.
I'm getting very worried. We have too many lawyers sitting in the audience, right? Either we have lawyers or we have faith. So, आपसे पंगा पड़ा तो उनके पास जाना पड़ेगा. अच्छा. No, I think we are one of the most complex judicial systems in the world. We have one of the largest outstanding I think, what do you call it, outstanding dockets in the world today. And I at least know 14, 15 different great legal tech firms solving it. The question now again to that same point becomes, when is it based and when is it not? I don't know if you've seen all those memes and reels where a US-based judge threw out someone's petition because it was written on AI, or someone sent an AI lawyer because they weren't able to appear on a digital hearing. So my point is, there are contours to each profession and what can and cannot happen, the complexity of it. But I do believe decluttering or improving efficiency is something that AI will be able to do in the legal world, definitely. Now the problem is, again, you have India. क्या है India में बोलते क्या बनोगे? CA, doctor, lawyer. You have a proliferation of people coming in, and if you have so much talent, I won't call it talent, I'll say so many people who have a degree of that but may or may not be qualified. If they start getting replaced by AI, it is going to create some sort of a pushback from the bodies to saying, no, we want to exclude AI because we need to make sure these people are gainfully employed. Now, are they truly gainfully employed or are they just employed is a question. So I feel the AI question is not whether AI can come in. The question is, will it be allowed to come in? Will it be accepted as a peer? And will that, with the value that it provide, become sort of table stakes? In most industries, okay. Legal, I'm not so sure.
That's all we have time for. Anybody else wants to take up that question? Yeah, go ahead, Vijay.
I will quickly because I understand the paucity of time. On the legal side, I will just give you one example and you understand how it will change. We recently was filing for SEBI for a 28-page document. It was framed in 1961 Income Tax Act. So I'm a chartered accountant, so we understand the 1961 Act. But then there is a recent change on 1st April, that is there is new Income Tax Act 2026 came into picture. It was the last date to file that document, and now my legal team is into a juncture that we have to relate all those 28 pages, redact all those 1961 references and bring the 2026 expenses. Last date, this is a 1 week job if 3 lawyers get into complete efficiency. I just gave that file to Claude, asked it to run all those changes, mark it as what all in track changes mode. It did the job. I was not convinced. I gave it to Codex, ran it again. It found 3 to 4 more points. My partner was still not convinced. He said, do we really file this with SEBI? Because SEBI is going to look at. We did our own audit, personal audits. There were close to 60 changes which it made. And we found each one of the change were done beautifully by the AI. So now I can understand how Claude, Codex, or whatever tool you use, they're going to uplift the quality of work done by lawyers, CAs, us. We are going to be out of business if we don't adapt and understand the power of AI. So that's just.
So I'm not talking about legal, but I'm saying across board, whether you're a teacher, you're an entrepreneur, you're a lawyer, I think AI will not replace you, but AI enabled will obviously replace you. So with that, I close this panel. It's been a learning experience, guys, and you just don't bring a lot of capital to businesses, you bring a wealth of knowledge. So thank you very much for joining today.